Hello traders, this is the RSI Reloaded part 4. In this video we'll discuss divergence, bullish divergence, bearish divergence, and a reversal. What is the difference between a divergence and a reversal, and how one can trade the divergence and a reversal like a professional traders. And this video is dedicated to the TS RSI Pro traders. Let's get started. RSI Pro Reloaded, RSI Reloaded, part 4. Let's get started. This is the RSI Reloaded part 4. If you have not watched the RSI Reloaded part 1 to part 3, you may do so before watching this video. Alright. In this video, we'll discuss the bearish divergence and the bullish divergence when we are using the RSI indicator, the relative strength index indicator. Okay. We are on a daily chart of the US dollar. Okay, the US dollar. Singapore dollar currency pair. This strategy is valid for stock, for commodity, for crude oil, for gold, when we are using the RSI indicator. We are using the RSI indicator period 18, nothing special about it. I just choose 18 instead of 14. I may use 25, I may use 50 or whatever. But I'm using 18 here. The important is to understand the stable data that is governing the indicator and to keep eyes on the price itself, the number one indicator. Indicators will give warning, but the price will give a direct signal. All right. We want to discuss a bullish divergence and a bearish divergence. Where we are using the RSI indicator. All right. A bearish divergence will take place when indicators display a lower high, but the price display a higher high. A bullish divergence will take place when the indicator display a higher low, but the price is displaying a lower low. All right, very important. That's a bullish divergence. My apology for traders, my attention is on something here. That's why I'm a bit slow now. Okay, let's move on. All right. So here we have a situation here of a bullish divergence. Moment please, that I'm trying to. We see that the RSI, there was a low here in the oversold zone. It's a typical bullish divergence. You will see the indicator go to the oversold zone, and then will come out of the oversold zone and display a higher low. I'm moving some line here. That's not what to do. Moment please. That's a typical bullish divergence. You see. You will see the indicator will go to the oversold zone, and then we come up a bit and then display a higher low. So we'll count the first low from the oversold and the second low above the oversold zone. We have a higher low. The first low is in oversold zone. The second low is above the oversold zone. And the price in this case, though the indicator has displayed a higher low, which is moving the movement of the price, because there was a bit of blah, blah, blah here. It's moving the price of the price. It's saying that what you are looking at here, ladies and gentlemen, is a higher low. It's not equal low. Though the price has displayed, equal low here, the indicator is telling us that after smoothing all this activity here, all I can see is a higher low instead of an equal low. We will call that a bullish, divergence. Sometimes the price will display a lower low when the indicator display higher low. Sometimes the price will display equal low when the indicator display a higher low. But we want the first low of the indicator to be in oversold zone, and the second one to be above, the oversold zone. This is the problem. When they see a divergence, they jump into a trend, they place a trend, especially those who are swing trading, and sometimes they lose. All right. Now remember, sometimes indicator can be distorted, which means they fail to catch up with the price and they are distorted. And trader will see a divergence and they will place a trade and lose because the indicator has been distorted. Sometimes, depending on the macroeconomic condition or some economy news talking about the trading triangle, trader will see a divergence, but the price will do something else. That's why it's so important to use the trading triangle, the market first. All right. So the S&P 500 is now at a resistance zone. We want to give priority to a sell signal for the stocks. Okay, but sometimes you will see a signal that are bullish like this. This is a warning. This is the setup. A trader will buy, but they fail to align their trading strategy with the market, and they will lose. And they will say, "Oh, this system is not working." But all the trader has missed is that he failed to align his strategy with the market. We are always trading the market. So this is a bullish divergence. Now, this is also the setup. We do not just place a trade now. As a GSCWSY trader, we will now go to the signal time frame and watch it. If it's truly confirmed on the signal given to us on a signal time frame, now we will switch to the entry time frame and take it from there. But ordinary traders, aggressive traders, will just place a trade here to buy. Sometimes it will work, sometimes it may not work. If they have excellent risk control, it won't be too bad for their trading account. But if they are just trading, here this was positive. Why? You can see, look on your left-hand side always. When we are trading, we are looking on our left-hand side. When we are driving, we are looking on our right-hand side. So you can see that there was a bearish progression that was here, and now it was stalled. Price was displaying lower lows, lower high, lower low, lower high. Price now is displaying equal low. Telling that the bearish progression that was taking place here is diminishing. It's a warning. Confirmation by the indicator. We do not just buy now. We will now go to the signal time frame until we receive a signal. If the signal has failed, we will come out and wait for the next signal using our entry time frame. We want to trade conservatively. We don't want to be aggressive and go ahead of the price. We want to wait for the price. That's what we want to do. I mean, it may suit some traders' trading style. Sometimes some traders may say, that's not my trading style. Okay, fair enough. So you see now this is a bullish divergence. And here, using the price of the number one indicator, you will say, if it's truly a bullish divergence, the price should go above this bearish trend line, at least. So from this daily chart, you will switch to another time frame and wait for a retest of this bearish trend line. So if you return back below the bearish trend line, you want to be out. It doesn't matter whether you see a bullish divergence or not. But what we have seen, traders see a bullish divergence, they buy. And sometimes they will lose because there are false, bullish divergence. The bearish divergence will take place when the indicator will display, a lower high, and the price will display a higher high. The scenario has happened here. But a bearish divergence, we want a bearish divergence to take place at the best resistance level. And we want a bullish divergence to take place at the best support level. Because the price going down, the price is looking for a better support level. It's a market principle, talking about trading like a pro. Price going up, price looking for a better resistance level. So when we see a divergence, which is a warning, we are now asking the next question. Is this the best resistance level? When we see a bullish divergence, it's a warning. We ask ourselves, is this the best support level? What has happened before, looking on the left-hand side? You see? So here the price was going up. We see a bearish divergence. Is this a best resistance level? So we start drawing the key levels on our chart. It's our chart. This is one here. So, but the warning was given to us in this zone, which is a kind of resistance level. So we know that there is a better resistance here. If you want to participate in this, we are careful. We want to pinpoint our entry point and take a true signal instead of gambling. Sometimes traders will place straight away trade here to sell, and they will kick them out. Price will come and retest the best resistance level before coming down. Here it did go down straight away. But you may decide to wait and say, bearish divergence. I'm waiting for the first, lower high taking place here. Confirmation of the warning, bearish divergence. First lower high, second lower high. Now it's becoming easy now. We have a warning, now the price in the bearish channel, 3 channels, rising, declining, horizontal, nothing else. Okay? Alright, so the bearish divergence has taken place here. It's a setup, it's a warning. We're now curious, we look on the higher time frame to see whether the indicator has been distorted or not. Okay, we use our trading triangle. Alright, we do some verification. We don't just jump into trading because money is involved. So now we switch to the signal time frame, waiting for signal, and then we go from there to the entry time frame. If the signal has failed, we will close the trade and wait for the next signal. Full stop. Okay, so this is it for the bearish divergence. Okay, what I say to traders, we want the first high to be in the overbought zone and the second one to be below it. In this case, it wasn't the case. You can see it was near the 70 level, but in normal condition, we will prefer the first high for the indicator to be above, to be in the overbought zone, and the second one to be below. Okay, that's what we will prefer. That's a typical bearish, okay, a divergence. Okay, all right, it makes sense, and it's also powerful. But traders that are using the Elliott wave theory, we know that false divergence take place in the first wave sometimes, and also in the third wave. Because as the first wave has moved from the congestion zone, out of the congestion zone, very bullishly, sometimes you will see the indicator are distorted. And you may see sometimes a false bearish divergence after the first bullish wave. All right? A trader will sell and hold, and they will lose because he just a pullback. We are just waiting for a small pullback before the beginning of the third wave. Sometimes also, because of the strength of the first bearish wave, you may see sometimes false, okay, bullish divergence at the end of the first bearish wave, talking about Elliott wave theory. And trader will start buying there as the third, okay, Elliott wave is preparing to start, okay. So false bullish divergence can be observed at the end of the first wave to the end of the second wave in the Elliott wave during the the downtrend, okay. And we see also false divergence sometime at the end of the first wave to the end of the second wave during the first bullish Elliott wave. We see very often false divergence in the third Elliott wave. Sometimes you will see clearly during the third bullish wave, you will see sometimes a distortion of the indicator, and trader will be selling because they see a bearish divergence, but it is the third wave. You shouldn't be selling. On the other hand, sometimes you may see a false, okay, bullish divergence in the third wave, in the third bearish wave. All right? The best place to see divergence is in the fifth wave. But sometimes, if the fifth wave is extended, trader get into trouble again. If they are trading indicator, because the price, the fifth wave is extended, and traders will see a bearish divergence in the bullish fifth wave, and they will sell while the fifth wave is extending itself. We know that one of the impulsive waves should be extended. Normally, the third wave should be the longest wave. But sometimes if the third wave is not the longest wave, then we have a higher probability chance that the fifth wave will be extended. When the third wave is not the longest or very strong, very often the fifth wave will be extended. Very often, talking about what has happened before is likely to happen again, talking about trading like a pro trading video, the principle that there's nothing new in the market, we will see equality between the first wave and the fifth wave, which means the length of the first wave can be exactly the same length of the first wave, equality. You see, so the divergence, we can have a false divergence. That's why we say to traders, it's a warning. So you see that, you see like this, just highlight it. You say, okay, it's bearish divergence, but I'm not selling yet. Okay, I'll wait for a signal. If the signal fell, I'll come out. Here you see a bullish divergence. You say, okay, it's a bullish divergence. I will wait. Look on your left-hand side to examine what has happened before. You see, look on your left-hand side, look what has happened before to align your strategy with the market patterns. You see, the first thing that we check is the market pattern. So there was a bearish progression and then a double top. Okay, here there was a, okay, the price started going up and then it stuck again at a resistance level. Okay, so you want to know, understand the language of the price before you can apply the divergence, to know your divergence in a void. Now, talking about reversal, there's something else we call a reversal. All right, the reversal is when the indicator is here. There's I think there's this one. Where are we? This no, we don't have a good one here. Reversal. A reversal will take place when the indicator will display a lower low. So instead of higher low, we have a lower low, but the price, okay, is displaying a higher low. Okay, this is one here, this one here. But it's not a good setup. I don't like this one. I would prefer it to have a low like this and another one right below. But if we consider this and this, because the price went over both zone before coming here, I don't like this. But just for explanation purposes, okay, a reversal is when the indicator displays a lower low, because there was a lower low here, a lower low compared to this one, this low here, compared to this one, a lower low, but the price is displaying a higher low. It's a reversal. The price is the number one indicator. We must follow the price. Okay, that's what I'm talking about. That's a reversal. The reversal also will take place when you see the indicator displaying a lower high, but the price will display, not a lower high, a higher high. The indicator will display, instead of a lower high, will display a higher high, but the price will display a lower high. That's a reversal. But always, whether it's a divergence or a reversal or a hidden divergence or blah 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 divergence, whatever you call it, keep eyes on the price, draw your channel. If it's a bearish, we must see lower high. If it's bullish, we must see higher low. The price will always, talking about the market principle, the principle that the market is following, the price is breaking one level and retesting that level and move to the next level. In the uptrend, talking about market principle, the price is looking for a better resistance level. In the downtrend, the price is looking for a better support level. As it's rolling it down like this, we see now, we know that, okay, it's looking for a better support level. So all we do, like the smart money, we highlight the support level already and see which one, okay, will hold it. And we are watching the activity of the price. Okay? We are now on the NAT psychological price level 12200. You see? All right? I hope you have enjoyed this video also about the RSI Reloaded Part 4 that you will put into use in order, okay, to cream the market consistently. We are the TSTW SYS 008 traders. Speak to you soon.